The Canadian inflation numbers came out this week and they dropped for the second month in a row. And while we're typically wary to call 2 months a trend, the underlying economic data shows that this is definitely going to continue its downward focus. So on Tuesday, the numbers came out and inflation dropped 0.6% down to 7%. As mentioned, this is the second drop in a row and now down from its high of 8.1% back in June. And unlike what we just saw happen in the States, that 0.6% drop actually beat the 0.3% expectations. So a little bit better off than expected. And the drop largely driven by gasoline prices. We saw that excluding gas, CPI was still down to 6.3%. Down from 6.6% the month before. The problem here, though, is that grocery prices are still increasing. And this is getting to be no joke. Grocery prices are up to 11.9% higher than they were last year. And not everybody drives, but everybody eats. So inflation clearly still being felt. We are far from being out of the water here. But again, nice to see the trend going down 2 months in a row. And we're going to get into some numbers here as well that say we firmly believe, like we believed last month, that downward trend in inflation is going to continue here. Quick look over at the wages here, average hourly wages as well. They're up 5.4% from last year. But again, those are in real negative territory, of course, when you're looking up at that 7% inflation rate. So August CPI numbers continue to show encouraging signs that inflation is slowing, not just by falling gas prices, but again, there's a softening in the rate of appreciation in core inflation, including transportation and shelter. Yes, as we know, housing prices are going down and that those numbers are starting to register here in our CPI overall. And a quick look over at bond yields, well, they're trending upwards. And that means that the markets are expecting even further hikes by the Bank of Canada. Not too surprised. They've basically come out and said just that they are going to continue as their number one mandate is to tackle inflation and get it down to their 2 to 3% target. So we know October 26th is the next day of that announcement, and that will come just after the next inflation print. So that print will obviously have some influence on what the BOC does here. But again, that's kind of where we're sitting with the numbers as of Tuesday.
And guys, just before I get into where we're going with rate hikes and what the rest of the world is doing as well, let me be the first to welcome you guys back to our channel. Obviously, I'm Ryan Dash, joined by my business partner and co-host, Dan Martell. Wordle, Dan, sorry, I decide which one I'm going to say when I say it. But we run a real estate team out of Vancouver, and we make educational YouTube videos and podcasts for our clients and our online community to make sense of this very complicated real estate market we are in. So we would love it if you gave us a big thumbs up, hit that subscribe, smash the bell. Because it helps the algorithm and other awesome people like you learn from the content we produce each week. Obviously, if you want to talk about your own personal situation, you can do that. Just simply reach out on either Dan's number or my number below, and we're happy to consult with you at any time. All right, Dan, so let's get back into it here. The next rate hike, where are we going? Is it 0.5? Is it 0.75? I mean, it's almost like these oversized rate hikes have become the norm now. But we're starting to really see, I think, the first sort of reaction from what would be the first rate hike that we saw this year. We're starting to see, like you said in the intro here, core inflation starting to drop, recede to some degree. I do think down south, we're likely going to see another oversized rate hike, mostly because their inflation data, it only came down, but by a very small margin, right? Almost a moot point in many ways. So I think we'll continue to see an oversized rate hike in the US. However, I think up here in Canada, things, with us beating the last inflation print that was expected, I think the Bank of Canada is now finding itself in a bit more of a precarious position than it was even just in the last 6 months. It was fairly easy for them to come off of such a low baseline and come up by 0.75 and as we saw 100 basis points and then 0.75 again, which really brought up the cost of borrowing very quickly. But now as we get into beyond the 3.5%, I think it gets far more difficult for the Bank of Canada because we're pushing beyond the realm of the stress tests and what the economy and the bandwidth it currently has. So, it's going to be very interesting to see. I think another point that we really should make people aware of is that over the summertime, consumers, they spend. That's the biggest time all year where we see spending habits exceed that of what it would normally be in the course of a year. And that's because people are going away, they're camping, they're traveling, they're spending more on fuel. They're having parties, barbecues, people over. So the cost of food, everything goes up. However, as we start to batten down the hatches and winter is upon us, we'll certainly see those behaviors change. And I think that that's not just the case in the housing market. We're seeing it across a lot of different markets. And we'll speak to those anecdotal stories shortly. Dan, why don't we talk a little bit about maybe the net worth of housing that's tumbled in the last little while?
Well, sure. With prices going up across the board and the cost of borrowing going up across the board, people are naturally pulling back. It's essentially the wealth effect happening in reverse. People don't feel wealthy when they're seeing their homes being worth less. And of course, gas and food being so expensive. People are getting into kind of a bit of a hibernation mode, naturally, a little self-preservation mode because they have to. Things are too expensive to be buying right now. So yes, Canadian households actually lost nearly $1 trillion worth of net worth in the second quarter alone. Nationally, $1 trillion worth of essentially equity has been erased. And that is going to be felt, understandably. If you bought a home for $1 million and you're looking at it now at $850, you're feeling less wealthy. If you look at that quarter between April and June, the value of residential real estate holdings held by households fell by almost half of that at $419 billion as well. And this is, the largest quarterly decline on record. And I will just reference how many times that we came out on this podcast during 2020 and 2021 talking about records going the other way. The pendulum was swinging very fast going up. Now we're seeing it swing very fast going down, and we're breaking records on the other side. So with all of this wealth and equity reducing to this effect, understandably, people are spending less. And yes, like Ryan said, it's also a different season. People felt good to go out this summer, the first real open summer post-pandemic. A lot of travel happened, and now people are saying, oh my goodness, everything is expensive. Let's hunker down here. A great example of this, and it's an extreme one, and basically another record, car sales, new car sales, were the lowest in 23 years last month. A perfect example of discretionary spending not taking place. And so when people are pulling back on things like cars, and I'm guaranteeing you other luxury items, your watches, your expensive gifts, etc., you're going to see inflation start to get under control when people aren't spending on these things.
Yeah, I don't think it stops there too. I think we're going to see more months of these kinds of headlines. I think it's just starting to see now the effects of these interest rate hikes, right? And I can even speak anecdotally. A good friend and client of ours who owns a business, he's a tradesperson. We were speaking yesterday about how, just 6 to 8 months ago, a lot of trade companies were just trying to keep up with demand. So they were spending an inordinate amount of money on things like work vehicles. And these work vehicles, they were spending, in excess of 50% of what would have been the market rate for these things a year ago or a year and a half ago, only to now see them being repossessed by lending companies and being resold for far less now to much more savvy business owners who waited that out. So we're really starting to see some of that fluctuation take place. And those who were patient and those who waited on the sidelines, they're starting to see some of these deals take place. And I don't think it's done, because as we continue to search through the headlines and what the media is coming out with, everybody is now talking recession, 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 except for the Bank of Canada, which I find interesting when we've got headlines from the World Bank who are saying there's actually fear of a global recession, not just a localized recession. And while each local economy would definitely deal with their own recession in different ways and different time periods, what's really interesting is this situation hasn't happened in the 5 decades we've been recording data. And that's because we've never really been in a position where the G7 nations, all of the developed countries in the world, and all of their central banks began raising rates all at the same time. So the synchronicity of these bank rates all raising at the same time is likely going to drive all the production and all of the growth into the ground around the world. So while we live in a very globalized economy, a very centralized one, I think the Bank of Canada, having been wrong many times before, is likely going to be wrong here again, especially when you see groups like RBC and TD and other major banks coming out and forecasting recessions for 2023, and yet the Bank of Canada still won't say that. I don't understand.
So what is that going to look like then? If we do go into a recession here, well, let's look at some data. And this comes from our friends to the south here in America. You look at like the last 100 years of data from the States, and they've gone through about 11 recessions during that time. And of course, these were all in varied lengths, but they averaged about 16 months to get back within the 2 to 3% inflationary target that they had. So are we going to see this repeat itself? If so, we're looking at about the end of 2023 for inflation to be under control, or at least to the point of the imaginary 2 to 3% range that was thought up to be normal. Now, I find the cycles to be tightening across the board. We're seeing house prices and the cycles that they go through tightening ever since 08, and then of course 12, 19, 20, and then here we are now dipping. So what am I saying? I think 16 months, I think we're going to see it, at least here in Canada, hit that 2 to 3% target in less than 16 months. Maybe it's 10 or so. Again, we're seeing drastic movements here right now that are still to be felt. Like Ryan touched on, the rate hikes that were started back in March are only really being felt now. And so the ones that happened in the last couple of months have yet to take full effect. And we're seeing things grinding to a halt across the board. I mean, you just have to look at the real estate sales volumes, for example. We're in here at the third 20-ish year low in sales volume month that's going to come out at the end of September here. 2012, 2008 kind of numbers is about what we can expect for sales volumes now. And then here you go. If you have 23-year low in car sales volumes, same thing. These are not small numbers. When we're talking 2023 year, kind of heights, or we haven't seen these type of numbers in double decades here. It really goes to show how extreme it is. And so because it's so extreme, I think we are going to see 2 to 3% in less than 16 months, closer to 10 if I had to put my hat in the ring today.
Yeah, interesting, because when we look at, I certainly think fuel prices will continue to drop to a point, which is going to be interesting because I was speaking to clients of ours who were just actually this last week spent a month in England over the summertime. And their energy costs, Dan, if you can believe it, I mean, I know we've read headlines about it. On average, they were spending between 50 and 60 pounds, British pounds a month on their natural gas. Those same prices now are in excess of 1,000 pounds a month. So how that affects the global economy and how that affects Canada, who's a nation of exporting resources, could be actually better for us in places like Alberta, for example, who, as long as we can get the natural gas out and to our partners, it could be good for the economy. We'll see, right? So
certainly aren't going out buying cars if you're just trying to keep the heat on.
That's just it. So the discretionary spending is gone. I think we'll continue to see some inflated prices in groceries and food because we cannot stop buying it. Where we will likely see some price reduction is in the fuel cost of delivering the food. So maybe in time we'll start to see those numbers come down. But I do think a lot of food prices will remain elevated throughout this time period. I just don't see them coming down right now, especially with, I mean, every other realm in their life has gone up tremendously. So people are going to be spending their money on the things they need to spend it on, not the things they want to spend it on.
Makes sense. And then, of course, the big question, and let's wrap up on this. What is this going to do to house prices? Nationally, we're already down 12%, and that's been the reaction largely of probably the first 2 or 3 rate hikes, not the 2 that came after that, and maybe the one that's coming after that here in October. Right now, again, hard to look out 10, 16 months, but I'm going to see at least another 8% coming off of the national prices, dropping it maybe 20% HPI off of the peaks. I will say Vancouver is going to react differently. I don't think we're going to see 20% here. I really don't. Interestingly, numbers in for September. Yes, we're 3 weeks into September. It's not all flushed out yet, but the last 3 months here in GVRD are actually very stable. Now, lots of things can happen between now and 10 to 60 months from now, though we are seeing, once again, GVRD acting very differently than the national averages, as it almost completely historically has.
And just in time, Dan, for the new year, we are going to get the cooling off period, which the timing is perfect for. And we're also going to get, before that, a foreign buyer ban across the whole nation to further cool down the market that's already cold. So, interesting to see the government trying to pull levers here that really don't do anything. I just don't see any of these things having a material impact on housing at this point here.
Right, of course. Yeah, the cooling off period came 2 years too late. And the interesting thing about the foreign buyer ban, again, we know that's just lip service, as there's been less than 1% of sales over the last 2 years were foreign buyers. Though the reason we wanted to bring this up is, personally, I've had 3 potential clients come to me in the last couple months here looking to buy in Canada and in BC that were foreigners and non-PR, not non-permanent residents. They had no idea this foreign ban was coming. And sure, that's only 3 people, though I feel that word has not been spread very well outside of Canada. There's a lot of Canadians that aren't aware of the foreign buyer ban. So we may see some interesting headlines come January 1st, January 2nd, when maybe people are vacationing in Whistler and fall in love with it. And guess what? You can't buy there. It may surprise a lot of people. So again, it's not going to affect housing prices, but it might have some interesting recourse on the way people look at Canadians and blocking out foreign ownership.
Probably a good place to wrap it up there, Dan.
Okay, perfect. Well, thanks as always for watching and listening, and careful out there. Food's expensive, gas is expensive, though we truly believe that it is trending in the right direction and things will be under control within less than a year. Thanks. Have a great day.